When most people talk about beating the market, they imagine a high-stakes poker game, or someone screaming while looking at a chart. But for me, the goal isn't to double the market's return or find the next rocket to the moon every week. Instead, I've set a very specific, data-driven target for my personal wealth. I aim for at least a 1% edge over the market return minimum. I want my overall portfolio to outperform the benchmark, typically the S&P 500, by just 1 percentage point in terms of its annual growth rate. Don't get me wrong, I'm not stopping at 1% outperformance. Some years you just have a really good year. It also sounds kind of small, but over a 30-year career, that single percentage point is the difference between a comfortable retirement and a truly wealthy one. I also don't want to oversell this as an easy feat to accomplish. Hedge funds around the world pay millions of dollars every year just to attain 1% of alpha. I don't claim to be any kind of investing genius. There's always risk, but I am a huge believer in setting goals. So here is the why and the how behind my 1% goal, and why I look at my Roth IRA as the primary tool to get me there. To understand why I'm obsessed with this number, we have to look at the math of compounding. Historically, the market has returned roughly 10% annually over the long haul. If I simply track the market in all of my accounts, and I invest $1,000 a month for 30 years, at 10% return, I'd end up with just over $2 million, which, by the way, is a fantastic result. But here's what I'm doing. I'm aiming for an 11% return over my entire portfolio. If I can use my individual stock picks to pull that total average up by just 1%, that same $1,000 a month turns into just under $3 million over 30 years. That tiny 1% difference nets me an extra $500,000 or so. That's over $500,000 created purely by making slightly better, more calculated decisions in a single account. Now, I view my portfolio as two distinct machines working together. First, let's talk about the baseline. At my job, I have both a 401k and a 457b. These are the foundation. Because I'm limited to a specific menu of funds, I use these to capture the market's natural growth. I'm not trying to be smart here. I'm buying the entire S&P 500 or a total stock market index. This ensures that no matter what, I will never underperform the market in the bulk of my holdings. It's my insurance policy against my own ego. Now, we look at where I attempt to gain my edge, which is my Roth IRA. This is where the pivot happens. I use my Roth IRA to hunt for that 1% edge. Since this account allows me to buy individual companies, I make high conviction, calculated bets on what I believe to be the highest quality companies in the world, at a price that allows them to outperform the broad market. So, why do I choose the Roth for this? First, the tax-free alpha. If I successfully gain that 1% edge, that extra $500,000 I mentioned earlier is completely tax-free. If I did this in a taxable account, a huge portion of my hard work would go to the IRS. Second, the controlled risk. I am not gambling my whole net worth. I'm taking a small, concentrated portion of my total assets, and I'm applying a rigorous analysis to it. So how do I get the edge? I don't need to find 50 stocks. I only need a handful of high-quality companies with sound long-term narratives. When I'm analyzing a stock for my Roth, I look for 3 specific markers. Number 1, the durability of the narrative. Is this company solving a problem that will still exist in 2035? I'm looking for structural winners, companies that aren't just riding a fad, but are becoming essential infrastructure for the future. Number 2, capital allocation. I want CEOs who are obsessed with shareholder value. Are they buying back shares when the stock is cheap? Are they reinvesting in the business at high rates of return? Finally, the reasonable entry. I'm looking for growth at a reasonable price. I'm perfectly fine paying a fair price for a great company, but I am not chasing stocks that are trading at 100 times earnings. I want to buy when the sentiment is low, but the fundamentals are solid. The biggest mistake I see people make is thinking that outperforming requires taking massive, unhedged risk. In my view, it's quite the opposite. I'm looking for calculated risk. This means I'm doing the work to understand the downside before I look at the upside. If a company has a great narrative, but a balance sheet loaded with high interest debt, it's a no for me. If a company has a great product, but no moat to protect its margins, I'll pass. By being picky and only letting the best of the best into my Roth IRA, I'm setting myself up to gain that 1% edge. I don't need to be a genius. I just need to be slightly more disciplined than the average investor who only buys what's trending on social media. So as I've stated, my goal is to maintain that 1% edge year after year. Some years I might be up 5% over the market. Some years I might lag it by 2%. But by staying focused on the compound annual growth rate, the long-term annualized average, I am building a roadmap to a level of wealth that a standard index fund alone simply cannot reach. I'm setting my own targets because I want my money to work as hard as I do. I'm using the index for safety and the individual stocks for the win. So that's going to be it for this video. If you like this type of content or you find it helpful, I'd appreciate it if you'd like it to push it out to more people. Again, I am a small creator with limited reach. Also, please consider subscribing. I do put out a couple of these videos each week, and I am always open to suggestions for other stocks or topics that we may want to investigate. That said, I appreciate your time. Thanks for watching, and we'll catch you in the next one.